Lifetime client value is the total revenue a client produces across the entire arc of the relationship. New business pays the bills. Lifetime value builds the agency. The agencies that reach scale are the ones that learn to multiply value per client, instead of constantly chasing new ones. This training is about how to do that on purpose. Most agencies measure success the wrong way. They count new policies written this month, they count new clients added this quarter, they run faster and faster on the lead generation treadmill, and they wonder why they're tired, but the agency isn't growing. The number that actually predicts long-term agency value is something different. It's lifetime value per client. The math is simple. Average annual revenue per client multiplied by the average number of years that client stays, minus the cost to acquire them. Run that calculation honestly, and most agencies discover something uncomfortable. They've been spending $300 or $400 to acquire clients who produce $150 a year and stay just under 3 years. The economics don't work, and no amount of new lead spend fixes that. Why this matters at the agency owner level? Because lifetime value is the lever that determines what you can spend on marketing, what you can pay producers, how much capacity the agency can absorb, and how the business eventually sells. A book with a $6,000 lifetime value per client is a fundamentally different asset than a book with a $1,500 lifetime value per client. Same number of clients, completely different valuation. There's also a hidden truth in the numbers. The retention curve is wildly different by policy count. Clients with one policy retain at around 82% annually. Clients with 2 policies retain at 91%. Clients with 3 or more policies retain at 96%. The simple act of moving a client from 1 policy to 2 changes the lifetime value calculation by years. 3 policies, and the math becomes extraordinary. 3 levers move lifetime value: retention length, revenue per year, and acquisition efficiency. We're going to work through each one. Lever 1, retention length. This is the simplest and most underused lever in the agency. Every additional year a client stays multiplies their lifetime value linearly. A client who stays 5 years instead of 3 years isn't 66% more valuable. They're often 2 to 3 times more valuable because the years compound when annual reviews surface cross-sells, which then drive retention even longer. 3 things drive retention length. First, the number of policies on the household. Bundling is the strongest retention force in the industry, not because of the discount, but because of the inertia. The more lines a client has with you, the harder it is to leave. Second, the depth of relationship. Clients who feel known stay. Clients who feel like an account number leave at the first price difference. Third, proactive contact. Clients you reach out to first don't shop. Clients who hear from you only at renewal do. Lever 2, revenue per year. Revenue per client per year is moved by 2 things: cross-selling additional lines and upgrading existing coverage as life changes. Most agents only think about the first one. The second one is bigger than they realize. Cross-selling first. Every Medicare client should be evaluated for life, hospital indemnity, dental, vision, and final expense. Every life client should be evaluated for retirement income solutions. Every commercial client should be evaluated for personal lines and key person coverage. The opportunities exist in every book. The question is whether the agency has a process to surface them systematically. Coverage upgrades second. The auto policy a client wrote 5 years ago is probably underinsured today. The life policy from when they had 2 kids may need a rider added now that they have 4. The business owner policy from when revenue was $300,000 needs adjustment now that revenue is $1.1 million. Annual reviews surface these. Most agencies leave them on the table. Lever 3, acquisition efficiency. The third lever is the one most owners ignore. Lifetime value isn't just revenue. It's revenue minus the cost to acquire the client in the first place. 2 things drive acquisition costs down: referrals and content. Referred clients cost a fraction of paid leads to acquire, retain at higher rates, and write multiple policies more readily. Content-driven leads from a blog, social media, podcast, or local search arrive with the prospect already pre-sold on you as the expert. Build both pipelines and lifetime value per client jumps without changing anything else. The combined effect is what matters. If you stretch retention from 3 years to 6, double revenue per client through cross-selling, and cut acquisition costs by 60% through referrals, you don't double lifetime value. You quadruple it or more. Same agency, same staff, same number of new clients per month. Completely different business. Here's how to operationalize this. Build the lifetime value scorecard for your agency. 5 numbers, updated quarterly. Number 1, average policies per household. The single best predictor of retention. If your average is below 1.5, retention will be a constant problem. Get that number above 2, and the agency stabilizes. Above 3, and it compounds. Number 2, annual revenue per client. Average it across your full book. Track the trend. If it's flat year over year, your cross-sell process isn't working. If it's growing, it is. Number 3, retention rate. Calculated as the percentage of clients who stay year over year. Track by tier. A tier should retain at 95 plus, B tier at 90, C tier at 85. If any tier is below those numbers, the system needs work. Number 4, referral rate. The percentage of new clients from referrals. Below 20%, you're spending too much on paid acquisition. Above 40, the agency has real leverage. Number 5, average client tenure. The average years a current client has been with you. This number rises slowly, but watching it move is one of the most rewarding metrics in the business. Run the scorecard quarterly, compare it to last quarter, the numbers tell the story. Let's walk through what this looks like in practice. Patricia owns a 4-producer agency that had been writing about 300 new clients a year. The scorecard told the truth. Average policies per household was 1.3. Retention was 86%. Referral rate was 12%. Average revenue per client was $1,800. She built a deliberate plan. The annual review system became the cross-sell engine. Every review walked through life, ancillary, and additional lines. Within 12 months, average policies per household climbed to 1.8. She built a referral system. Every closed deal triggered a structured referral conversation 30 days in. Referral rate climbed from 12 to 28%. She tightened retention. The 5-part annual review framework rolled out across the agency. Within 18 months, retention rose to 93%. The scorecard at month 24 looked completely different. 1.9 policies per household, 93% retention, 28% referrals, $2,300 revenue per client, same staff, same lead spend. The lifetime value per client more than doubled, and so did agency profit. A few common mistakes to avoid. The first is chasing new client count instead of lifetime value. 300 clients producing $2,000 a year with 85% retention is dramatically more valuable than 500 clients producing $1,000 with 75% retention. Count the right thing. The second is treating cross-sell as an annual project. Cross-sell happens in the moment during the review, with a defined process. If it's not in the review agenda, it doesn't happen consistently. The third is ignoring the C tier. Even C-tier clients have lifetime value, and they often have more of it than agents assume because they refer family and friends who become A-tier. Don't write off any client. The fourth is failing to measure. The scorecard isn't optional. The numbers you don't track are the numbers that don't move. Here's your action step. This week, build your scorecard. Pull the 5 numbers: average policies per household, retention rate, referral rate, revenue per client, average tenure. Write them down. Then commit to one specific lever for the next 90 days. Pick the one with the most room to grow and design a system to move it. Lifetime value isn't a marketing concept. It's the operating philosophy of every agency that scales. Build it into the scorecard, run the system, and the agency starts to grow on top of itself instead of treading water against churn.